From your perch, I know a lot of your rivals and you are looking at the holes that this may cause in the economy and in the credit markets, frankly. What are you most concerned about when you look at how the regional banks are faring?
Yeah, well, again, thanks for having me. It's great to be here this morning. Obviously a tough day for the regional banks. I think a lot of people are hoping, yesterday's news with First Republic would have maybe been a stop to that. But I think you have to remember there's been no sort of credit issues at these banks yet. It's been sort of liquidity. I think that credit is an overhang. Right? Are we looking at a recession, the second half of this year, is at the beginning of next year? How severe is it going to be? What risk, exists on those sort of banks' balance sheets? And I think you have the further overhang of, will there be increased regulation? Will they be able to make acceptable, returns for their investors? And then I think that, the broad stroke about maybe what are we worried about, will that, result in credit contraction? Right? I think that's probably bad for the overall economy. That probably does present an opportunity sort of for folks in our shoes.
I do want to talk about the credit contraction with you, but first, we've been going through this for weeks now. This idea of the pain that the regional banking system, you see it in the bonds, you see it in the stocks. You just said the recession fears that could go into 2024 at this point. Does that mean the system will be under stress, the regional banking system, through that time?
I think it could be. I mean, it's in my mind, there's kind of that recession sort of coming. I think we can have the debate about how mild or sort of how severe. I don't think it's going to be overly severe. I think it has a chance to be a sort of a pretty fast sort of moving point. But the consumer's still pretty strong. I mean, there's other results out from consumer-focused businesses today that were showing strong numbers in travel, people sort of spending sort of money. So I think that's sort of delaying it sort of a bit. I mean, a little bit of softness in jobs numbers today, but I think those numbers are probably still well beyond anything we would have seen in 19. So, on one hand, I think the economy is performing, but I think there's that concern about, what's the forward going to look like and how's it going to play out?
With the regional banking system, I'm really curious about the role that private credit plays. A lot of talk about Blackstone, Apollo, partnering with a lot of these firms. PacWest was one of those firms that got a private credit line. It's collateralized, but I do want to point out that PacWest is one of those banks that is falling pretty heavily today. So, what are the limitations and what are the opportunities of where you can invest?
I mean, I remember, so our business on the private credit side, we do a lot with banks as kind of normal course of business, right? We've got a almost $40 billion AUM effort in what we call asset-based finance. We've got almost 40 people dedicated to that, focusing on these assets, consumer mortgages, hard assets, leasing, sort of, et cetera. So we can lend money to them, we can provide them solutions to provide capital. I think that will continue, and I think that's a global point, not just a US point. In terms of what the opportunity is as banks just generally shrink balance sheets or stepped out of lending businesses, private credit can come in and sort of fill that void, right? That's happened in direct lending, and that's been a big story for you all for some time.
But where won't you touch at this point? What is too risky for you?
Yeah, I mean, there's a lot of places that we're not, what I would say, overly focused on. I think as I said, the U.S. consumer's performing well, but there's parts of that market, sort of the deep subprime, that's not for us. I think there's certain, long-dated, energy-related leasing assets, sort of not for us. I think we've got areas of real expertise, whether it's in sort of resi, whether it's in auto, and other leasing type assets. So I think it's a market to be mindful about risk, but I think there's opportunities there to deploy capital.
Do you have concerns about residential real estate?
I don't really. I mean, I think if you go back to that was the story in 07, 08, there was a lot of speculation, and quite frankly, it was very easy for almost anyone to get a mortgage. Right? It's been very difficult for anyone to get a mortgage in this country for 15 years. There's been very little speculation. I think there's still a lack of available housing stock in this country, and I don't think that a lot of people want to sell their house if they have a cheap mortgage today to go into a higher price mortgage, right? So I think that supply-demand, balance keeps that in check. I think there'll be certain markets that get hit pretty bad, but I think if you looked at where they were in 19, you remove the COVID run-up, it actually would be, still net positive.
Let's talk about the safest market, presumably in the credit markets, it's the Treasury market. When you look at what's happening in Washington and the discussion around the debt ceiling, what concerns you? What risks does that pose to the financing markets? Yeah,
I mean, I think you're going to hear a lot about the debt ceiling the next handful of weeks, right? I think for a long time, at least in my mind, that was an issue that just would get solved. Right, there would be a time that they would sort of debate it. I think both parties pretty polarized, though, sort of on the topic. I think that's going to, worry the market. I don't, I think they've actually talked this morning about a meeting for like May 8th to sort of address that. But it's going to create volatility, right? I mean, I suspect it gets solved, but it's going to create volatility. I think the market's not going to like that broadly. Again, that's probably good for folks who have capital like us, right? We can sort of step in, volatility is times when private credits, it should shine. So I think that volatility will continue, honestly, probably through the rest of the year beyond even the debt ceiling.
Now, what does this mean for the ripple effects here? The Treasury market is the heartbeat here of the financing markets at large. What's a bigger deal to you, the regional banking system kind of breaking here, or are you really worried here about
I think one's short-term, one's long-term, right? So I think the debt ceiling is going to be the conversation short-term, no matter, maybe what the move was on regional banks today, right? But I think the regional bank point will play out for, several quarters, maybe several years, right? You've got just, the balance sheet points, you've got the regulation points. I mean, I think there's plenty of regional banks that are very strong, but I think the market just needs to get comfortable on what returns they can generate forward on sort of the loan books, et cetera. So I think one's short-term, one's long-term.
Dan, a lot of questions here. What is left to break as rates continue to rise a little more? What's left?
Break in the sense of, I think the Fed's been on this path to raise rates. I suspect there's sort of one more coming. My bigger worry, a month ago or 2 months ago was that they were going to continue raising. And then I think at some point, if the short term was at 6% or some very large number, you'd get real stress on corporates, you'd get real stress on other real estate or things that might be sort of cap rate driven. I think the Fed stops after the 25 basis points, but then they hold steady there for a while.